Hello everyone out there in tax land and the tax man here. Listen, taxes don't have to be hard. Here we take complex tax subjects and we make them easy because we want the average taxpayer to understand, to benefit, and to save money. And today we're going to be talking about a pretty serious topic. That's the tax consequences of deceased taxpayers and inheriting property. You know, a bit of an uncomfortable topic, yes, but virtually everyone's going to have to deal with it at some point in their life. So we may as well give to you the basics of understanding the tax ramifications of deceased taxpayers and inherited property. Let's get to it. Now, when we're talking about deceased taxpayers, there's really two tax responsibilities. The first one is filing any unfiled returns, and the second one is dealing with any potential estate tax issues. Now, when it comes to filing back tax returns, the most you're going to need to file is the last 6 years of returns, and you need to file a tax return for the decedent up through their year of death. If they died in 2021, you have to file a return through tax year 2021. Now, frequently when we're dealing with deceased taxpayers, there's several years of unfiled returns. It's very common. The hardest part about this is going to be finding all of the tax documents needed to file those returns, things like Form 1099-R, maybe an SSA 1099. If you're able to find them, fantastic. If you can't find all of them, the IRS does make available something called a wage and income transcript. The wage and income transcript has most of the information you're going to need and all of the tax forms that the deceased taxpayer received in any year that you're requesting. And those go back up to 10 years. Now, to show the IRS that you have the authority to access that deceased taxpayer's account, you're going to need to fill out something called a Form 56. And you're going to need to attach to that form proof that you have control over their affairs. Something like a trust or will document showing that you're the executor, or a death certificate listing you as the surviving spouse or surviving relative. Send that in, and the IRS will be able to give you those wage and income transcripts and any other information you might need about the account that will be helpful in filing those back tax returns. And filing those back taxes is really crucial for this next step, which is to make sure that any back income tax or estate tax is paid before any property in the decedent's estate is sent out to any heirs or beneficiaries. It is possible that if the decedent has a significant estate, that some estate tax might be due, but before you get overly worried about it, note that in 2021, the estate has to be bigger than $11.7 million when we talk about the fair market value of any cash, property, and lifetime gifts of that deceased taxpayer. So the vast majority of Americans pass away with zero estate tax due. The basic responsibility for anyone handling the account of a deceased taxpayer at this point is just to make sure that any back taxes are paid before any items owned by that deceased taxpayer are paid out to any of the kids or other heirs. You want to make sure that the IRS gets paid first. Now let's talk about the tax consequences of receiving property from a deceased taxpayer. Now, most property from deceased taxpayers passes outside of the estate and probate process, and there's some very favorable tax treatment to receiving property in this way. From a tax perspective, at least, there's no better way to receive property than to inherit it. First, let's talk about inheriting cash. I am pleased to report that there is absolutely zero tax due if you inherit cash. It does not need to go on your tax return. That cash does not need to go anywhere except in your pocket, 100% tax-free. Next, let's talk about retirement accounts. If you inherit a 401k or IRA from a deceased taxpayer, there is no tax due when you receive that account. Now, when you start taking out distributions, depending on what type of retirement account it is, you might need to pay income tax. But even if you pay income tax, you will avoid the real sting with taking money out of these retirement accounts, which is that 10% penalty for early withdrawals. And you'll avoid it even if you're younger than 59 and a half. So you still get a nice tax benefit even if you need to pay income tax on those withdrawals. Next, let's talk about inheriting property like stocks or a house. I'm happy to report that when you receive these via inheritance, there's no tax due right away. You're only going to pay tax once you sell that property. And get this, typically when you sell appreciated property, you pay tax on the difference between what you bought it for and what you sell it for. So if you buy stock for $5 and then you sell it for $15, you pay tax on the $10 gain, not on the full $15 sale price. But if you inherit property, you get what's called a stepped up basis, which increases the basis of that property to the amount of the fair market value of that property on the date the decedent passed away. So let's say Dad bought GM stock in the 70s for $10. Then when he passed away, the stock was worth $100, and then I sell it for $105. So if Dad would have sold that stock the day before he passed away, he'd pay tax on $90 worth of gain. $100 the day he died, $10 when he purchased it. But if I receive that by bequest while the stock is worth $100 and I sell it for $105, I'm only paying tax on $5 worth of gain because I've got that stepped up basis, which increases that purchase price, that basis, up to the fair market value of that property on the date he passes away. And it works the same way for selling other inherited property like a house. When it comes time to compute your gain and your tax, we're not going to be using the purchase price that mom and dad had when they bought it back in the 80s. No, we're going to use the purchase price of the decedent who gave it to you on their date of death. And the net result is that when you sell that house, you're probably going to owe little or no tax due. And the last type of inheritance that frequently comes up are life insurance policy proceeds. Now, I'm happy to report that as long as you were the named beneficiary on that life insurance policy, the proceeds that get paid to you are 100% tax-free. They do not need to be reported on your tax return. The only place they need to show up is in your bank account, 100% tax-free. Now, if you'd like help filing back tax returns for a deceased taxpayer, or if you've received or sold inherited property and want to make sure that your taxes are done right, give me and my team a call. We deal with these issues all the time. Give us a call at 1-800-424-8332. O, si prefiere español, 888-523-6606. Ladies and gentlemen, I hope you've enjoyed this video. If you like what you saw, why don't you go ahead and give us a like or a subscribe. That way you can stay up to date on all the latest tax news and information. I am Dan, the Tax Man, tax professional with Community Tax, and I will see you next time.